Welcome to Into the Margins, where we explore the stories, strategies, and decisions behind profitable businesses to inspire the next generation of entrepreneurs. I'm Al Donovan, editor at Into the Margins.
And I'm Allison Bennett, business journalist at Into the Margins. So imagine a founder who just generated $2 million in revenue last year.
Okay, sounds pretty good so far.
Right. It sounds like the dream. They open their banking app on a random Tuesday morning. They look at a balance of like $300,000 sitting right there in checking, and they just feel this massive wave of relief.
Oh, I mean, of course they do. Seeing a six-figure balance gives you that huge dopamine hit.
Exactly. They think they've completely made it. But behind the scenes, that exact same business is actually practically bankrupt, like spiraling toward insolvency within the next 60 days.
Wow. And the crazy part is that happens all the time.
All the time. And today, we are pulling from a massive stack of financial case studies, business autopsies, and accounting frameworks to really figure out exactly how a disconnect like that happens.
Right, because we are unpacking the profit and loss statement, which is also known as the income statement.
Yes. And the entire mission for this deep dive is to fundamentally shift how you view this specific document. Because, I mean, if you just think of it as some tedious spreadsheet that you grudgingly hand over to a CPA in April, you are entirely flying blind.
You really are. I mean, it is the ultimate diagnostic tool. And our goal for the conversation today is to, elevate the P&L from being just this frustrating tax chore into a truly dynamic strategic instrument.
Yeah, moving it from defense to offense.
Exactly, because when you actually understand the mechanisms at play here, you finally stop guessing. You start using hard data to, spot operational leaks, model future growth, and secure capital.
And maybe, most importantly, avoid the psychological traps that completely distort your view of what your business is actually worth.
Oh, absolutely.
So let's start right there with the psychology, because that $2 million founder we just imagined, they are suffering from a very specific, incredibly widespread delusion. We call it the bank balance fallacy.
The bank balance fallacy.
Yes.
It's so dangerous.
Right. You open the app, you see six figures, and your brain just goes, well, the cash is there, so the business must be incredibly healthy.
But that single number is, quite frankly, a dangerous liar.
Right. It's totally static.
Exactly. It is a completely static snapshot of a single second in time. It completely lacks the dimension of time and, honestly, the dimension of obligation.
Obligation. Say more about that.
Well, that high balance feels like success, right? But it completely ignores your pending liabilities. Like, What about that massive vendor invoice sitting on your desk that is due in literally 3 days?
Oh, right. Or the quarterly tax payment that's looming at the end of the month.
Exactly. Or just the baseline overhead costs that are quietly draining your resources week by week. The bank balance only tells you what cash happens to be resting in that specific account at that exact second.
It does not tell you what you are actually keeping.
No, not at all.
It kind of reminds me of, it's the difference between an X-ray and an MRI.
Oh, I like that. How so?
Well, if you go to the doctor, an X-ray just shows you the rigid bone structure right this second. It's a snapshot. So your checking account is basically the X-ray.
Right. It doesn't show you the whole picture.
Exactly. But an MRI, that shows the blood actually flowing through the tissue, right? The ongoing functioning of the entire system over time.
Yes.
The P&L is the MRI. It measures the lifeblood of the business over a specific defined period, usually a month, a quarter, or a year. So you can see if the organism is actually thriving or, slowly bleeding out.
That is the perfect way to visualize it. I mean, relying on the X-ray alone is exactly how profitable-looking companies suddenly collapse out of nowhere.
Because they had no idea they were bleeding internally.
Precisely. The P&L replaces that gut-feeling guesswork with objective reality. But to actually read the MRI, to interpret what those vital signs are telling you, you have to understand the specific components of the math.
You need to know how the machine is built.
Exactly. You need to understand the 4 core buckets.
Right, because knowing you might be losing money isn't really enough. You need to know exactly where the leak is occurring.
Exactly.
So let's break that math down. The first bucket, sitting right at the very top of the statement, is your revenue. The top line.
The fun number.
Yeah. This represents all the money earned from your core operations during that specific time period. Like if you sell physical goods, it's your product sales.
Right. Or if you are a consultancy, it's your service fees.
Exactly. It is the gross amount of money flowing into the top of the funnel before absolutely anyone takes a cut.
But obviously the money doesn't just stay there.
Which brings us to the second bucket, and this is honestly where the strategy really begins.
Okay, hit me.
Cost of goods sold, or COGS as it's usually called. This metric represents the direct costs that are explicitly mathematically tied to producing your specific product or, delivering your service.
So we are talking about, like, the raw materials here. Raw materials, yes, but also the direct hourly labor required to physically assemble the product, or even the freight and shipping costs to get that specific unit into the hands of the customer.
Got it. And when you take your top-line revenue and subtract those direct costs of goods sold, you arrive at your gross profit.
Exactly. Revenue minus COGS equals gross profit.
But wait, let me just push back on this for a second. If I am paying people to work for my company, cash is leaving my business. I mean, money out is money out.
Right.
So why does it matter if I put a salary in the COGS bucket versus the next bucket we're about to talk about? It feels a little bit like splitting hairs when the cash has literally gone either way.
Well, it definitely feels that way at first glance, but miscategorizing those costs is exactly how founders trick themselves into scaling a fundamentally broken business model.
Okay, how so?
You have to separate the engine of your business from the chassis. Your COGS is the engine. The third bucket, which is operating expenses, or OPEX, that is the chassis.
Okay, define OPEX for me then.
OPEX covers all the overhead required to keep the lights on and basically run the business. But crucially, these costs aren't directly tied to producing a single unit of your product.
Ah, okay. So like the rent for your office space.
Exactly. Rent, your marketing budget, the salary of your administrative staff, your HR department.
Expensive software subscriptions.
Yes, those SaaS tools. These are the structural costs of merely existing as a company. And when you take your gross profit and subtract those operating expenses, you get your operating profit.
So it's essentially isolating the disease. Like if you lump the engine and the chassis together in one big category, you have absolutely no idea why the car won't run.
That's a great way to put it.
Let's ground this with a real example. Say you run a custom high-end furniture business.
Okay, I love a good furniture analogy.
Right. So the mahogany wood, the hardware, and the hourly wage of the master carpenter who is actually physically building the dining table, those are your cost of goods sold, your COGS.
Right, because every single time you sell a table, those specific costs are triggered again.
Exactly. But the monthly rent for your really flashy downtown showroom, the salary of the receptionist answering the phones, the, thousands you spend on Instagram ads, those are operating expenses, OPEX.
Spot on. And by splitting them up on the P&L, you can actually diagnose the exact health of the business.
Because they tell you two totally different things.
Exactly. You might look at your MRI and realize, wow, my gross profit is fantastic. It only cost me $500 to build a table that I can sell for $3,000.
So the core product is an absolute cash machine.
Yes, but then you look further down and see, oh, wait, my net profit, the final bottom line after all expenses, is actually zero.
Zero. Because the showroom lease and the massive ad spend are just eating every single dollar of that gross profit.
Precisely. It tells you that the fundamental business model actually works, but your ego or your overhead is completely suffocating it.
And I guess on the flip side, what if your gross profit is just razor thin?
That's the scarier scenario, honestly.
Right. Like, what if the wood and the carpenter's labor cost $2,800, but you're still only selling the table for $3,000?
Well, in that scenario, it honestly does not matter how many times you renegotiate your showroom rent or how aggressively you slash your marketing budget.
Because the engine itself is broken.
Exactly. The core product is simply too expensive to produce, or you are just severely undercharging for it.
Oh.
You have a fundamental pricing or supply chain issue at that point.
You literally cannot cut your way to profitability if the engine is broken.
Exactly. That is why the distinction between COGS and OPEX is arguably the most critical strategic insight on the entire document.
It strips away all the vanity metrics, which I suppose brings us directly to the fourth and final bucket, net profit or net loss.
The true bottom line.
The ultimate truth teller. This is the final verdict remaining after absolutely all expenses, and we mean all of them, including taxes, interest, and depreciation, are subtracted from your revenue.
Right.
So now that we understand the anatomy of this document, revenue, COGS, gross profit, OPEX, net profit, let's talk about how we actually wield it.
Yes, because just hoarding this data in a spreadsheet is useless if you don't use it to make moves.
Right. This is where the P&L totally transcends just being basic accounting and becomes the primary tool for strategic decision-making.
Absolutely, because as an entrepreneur, you face constant, really high-stakes forks in the road.
Mm.
You know, like, can I afford to hire a dedicated operations manager this quarter?
Right. Or is it financially safe to expand our product line right now?
Or should we double our marketing spend on this new holiday campaign? I mean, if
Yeah.
you make those decisions based on that dopamine hit from your checking account, you're essentially gambling with your livelihood.
Just rolling the dice?
Pretty much. But the P&L allows you to look at your historical margins and actually mathematically forecast the future.
Okay, let's put this to the test. Let's look at a massive decision almost every successful brick-and-mortar founder faces at some point: expansion. You are running a thriving retail shop.
Yeah.
You've got great foot traffic, the bank balance is high, and you are really feeling the momentum.
Dangerous territory.
Very. So you want to expand into a second location across town. And the gut feeling says, well, I have one successful store. If I build a second one, I will simply double my profits.
Which makes intuitive sense, but it's rarely true.
Right. So how does the P&L shatter that assumption and force a real reality check?
Well, the P&L forces you to model the brutal reality of operational drag. To forecast that second location, you have to look at your current operating expenses, your rent, your baseline utilities, your store manager salary, your point-of-sale software.
Because if you open a second location, your OpEx is basically going to double overnight.
Right. You now have 2 commercial leases, 2 utility bills, 2 sets of management salary.
Okay, so then what?
Then you look at your historical gross profit margin from score number 1.
Yeah.
And you have to ask yourself a very tough question. Does the projected new revenue from this completely untested second location generate enough gross profit to cover a massively increased overhead?
Oh, wow.
Yeah. And the P&L might reveal a terrifying secret. It might show that your current margins are only surviving because your rent at location 1 was signed like 5 years ago and is an absolute legacy steal.
Oh, that happens all the time.
Or, even more commonly, maybe location 1 is only profitable because you, the founder, are working 80 hours a week for free.
Right, acting as totally unpaid labor to keep the margins up.
Exactly. But you can't clone yourself for location 2. Once you actually have to pay a real market rate salary for a manager at the new store, the margins might completely evaporate.
It takes the emotion, the ambition, and really the ego completely out of the driver's seat.
It forces you to prove, with historical evidence, that the expansion is viable before you go and sign a 5-year commercial lease that could literally bankrupt your entire life.
That is incredibly sobering. And, you know, speaking of proving viability, there is another non-negotiable reason you absolutely must maintain this MRI.
Access to leverage.
Access to leverage. Because if you want to scale, eventually organic cash flow just won't be enough. You will need banks, lenders, or outside investors. And let's be absolutely clear about how those entities view your business.
Oh, they do not care about your gut feeling.
Not at all.
They do not care about your vision board. And they certainly do not care about a screenshot of your bank balance on a random Tuesday.
Right. They want the real data.
Exactly. Institutional capital requires a profit and loss statement to assess the true historical financial health of the asset they are investing in. They want to see the trends.
The narrative.
Yes, the narrative of your margins over the last 36 months. Like, is your revenue growing while your operating expenses stay relatively flat?
Which is the dream.
Which is the dream. Or is your revenue growing, but your overhead is spiraling out of control, constantly eroding your net profit?
Because if you walk into a bank asking for a $500,000 loan to fund that second retail location, and you cannot produce a clean, accurate, multi-year P&L,
You look like an amateur.
the conversation is basically over before you even sit down.
Absolutely over.
And beyond the banks, I mean, there is the most unavoidable reality of all. The government. Tax season.
Oh, the dreaded tax season.
Right. While the P&L is fundamentally a strategic dashboard, maintaining a precise one makes filing significantly faster, vastly less stressful, and incredibly more accurate.
Because when your income is properly documented and your expenses are rigorously categorized, you aren't spending April in a total panic.
Digging through shoeboxes of faded receipts.
Exactly. And more importantly, it ensures you actually capture all those legally owed deductions that disorganized founders bleed out every single year.
But, and this is a massive but, this hinges entirely on the data actually being accurate.
Oh, definitely.
Because if your dashboard is feeding you lies, you're just going to drive the business straight off a cliff. So we need to examine the common mistakes. The hidden traps where intelligent founders routinely sabotage their own data.
And it happens to the best of them.
Mm.
I mean, the mechanics of building the P&L are straightforward enough on paper. You collect your records, you sum up your income, log your COGS, track your OPEX, and calculate the difference.
Pretty simple math.
But the execution requires relentless discipline. And the absolute biggest mistake, the trap that destroys the integrity of the data faster than anything else, is the mixing of personal and business funds.
Yes, the commingling of funds.
It sounds like rudimentary business advice, right? But the frequency of this error among otherwise brilliant operators is honestly staggering.
I've seen it so many times. Founders use a personal credit card to pay for a business software subscription just because it was, convenient in the moment.
Right. Or they use the business checking account to pay for a personal dinner because they left their wallet in the car.
It's the classic, I am the business is me, I'll just pay myself back later mentality.
And it completely obliterates clean accounting.
Because it renders the P&L a total work of fiction, right?
Exactly.
Yeah.
You are no longer relying on objective data. You are relying on your memory from 8 months ago to try and parse out what was a legitimate, deductible business expense and what was a personal indulgence.
Which is impossible to do accurately.
It corrupts the entire document. If you do not maintain completely siloed, dedicated accounts, your net profit number is nothing more than a guess.
A dangerous guess. Which leads us to the second major trap. We can call this one death by 1,000 cuts.
Oh, the micro expenses.
Yes, the complete failure to track the tiny everyday expenses. Because founders are usually pretty meticulous about tracking their massive inventory orders or running payroll.
Sure, the big numbers are easy to remember.
Right, but they completely ignore the small, recurring, seemingly invisible purchases. The $25 a month project management software, the $50 cloud storage upgrade.
The quick coffee runs for the team on Fridays.
Exactly. It's so incredibly easy to justify it by just saying, oh, it's just $20, it doesn't move the needle.
But it absolutely moves the needle. Those untracked micro expenses aggressively erode your profit margins over time.
Because they add up fast.
Oh, incredibly fast. If you have a dozen small, forgotten SaaS subscriptions quietly hitting your accounts every single month, that is thousands of dollars a year leaking straight out of your bottom line completely unmeasured.
And what does that do to the P&L?
Well, that artificially inflates your operating profit on paper, meaning you might make a strategic decision like hiring a new employee based on cash that doesn't actually exist.
Wow. So the P&L must be ruthlessly comprehensive. Every single dollar out must be categorized, or the dashboard is straight up lying to you.
It has to be airtight.
Yeah.
Which brings us to the third trap. And honestly, this is the one that is conceptually the most difficult for founders to internalize.
Okay, let's hear it.
Ignoring non-cash costs, specifically the failure to track depreciation.
Depreciation. Okay, so depreciation is essentially defined as the loss of value in your physical equipment or assets over time, right?
Right.
But wait, let me play the skeptic here for a second. If I buy a delivery van in cash today for $50,000, the money has already left my account.
Yes, the cash is gone.
The pain of the purchase is totally over. So why do I need to keep logging a mathematical loss on paper for the next 5 years? I'm not writing a check for depreciation to anybody every month. It feels like redundant imaginary math.
It feels imaginary right up until the exact moment it bankrupts you.
Okay, break that down for me.
This is a massive hurdle for operators to grasp, but here is the sobering reality. Depreciation reflects the true, unavoidable physical cost of doing business in the real world.
The real world wear and tear.
Exactly. Let's follow your delivery van scenario. You pay $50,000 in cash today. For the next 5 years, that van runs perfectly. It delivers your goods, it satisfies your customers, it drives up your top-line revenue.
Sounds great so far.
But every single day, every time you turn the key, that van is slowly dying. The transmission is aging, the engine is wearing down, the physical asset is quite literally evaporating into thin air.
Right.
If you do not account for that continuous loss of value on your P&L as a monthly or annual depreciation expense, you are artificially and massively inflating your perceived profitability.
Wow. Because I'm pretending the van will live forever.
Exactly. Your net profit looks incredible on paper because you are completely ignoring the fact that your core operational asset is actively deteriorating into scrap metal.
So you think your margins are, say, 20%, but they're actually more like 5% because the equipment keeping you alive is quietly expiring in the background.
Exactly. And then here's what happens. In year 6, the van's engine finally blows. and you suddenly desperately need $50,000 in cash to replace it just to keep the business functioning.
But you don't have it.
No, because you didn't track that depreciation. Because you thought your profits were much higher than they actually were, you probably extracted that cash out of the business as owner distributions. You already spent it.
Ouch.
Now you have to take on emergency high-interest debt just to survive.
Yeah.
Factoring in depreciation is how you budget for the inevitable breakdown of the physical world.
It ensures your dashboard reflects the complete, unvarnished truth about what it actually costs to sustain your operations.
Exactly.
You are basically forcing yourself to acknowledge the real price of the future. I mean, if you don't track the degradation of your assets, you are actively stealing from your future self.
That is a brilliant way to phrase it.
This brings us all the way back to the tension we started with, really. We have seen exactly why checking a bank balance is just looking at an X-ray. It's completely blind to the diseases lurking underneath the surface.
Right.
We've broken down the anatomy of the math, right? You've got the top-line revenue, the engine of your COGS, the chassis of your OPEX, and the ultimate truth, your net profit.
And we've explored how isolating those variables dictates whether, a second location is going to be a triumph or an absolute tragedy.
And how it satisfies the rigorous demands of institutional lenders.
Yes. And of course, we've navigated those tricky psychological traps, commingled funds, invisible subscriptions, and the silent, deadly drain of depreciation.
So the overarching takeaway here is that your profit and loss statement is fundamentally the central nervous system of your business.
It really is. It is the roadmap that tells you exactly where you have been, where you currently stand in objective reality, and where you actually possess the mathematical resources to go next.
Which means we want to leave you with a final, slightly provocative thought for this deep dive.
Oh, I'm ready.
We've talked entirely about how the P&L reflects the financial mechanics of your business. But what does it say about your psychology? Take a hard look at your operating expense ratio right now. If your OPEX is drastically outpacing your cost of goods sold, ask yourself a deeply uncomfortable question. Are you funding your actual product? Or are you funding your ego?
Oof. That is a tough question.
It is. Are those bloated administrative costs, that premium office space downtown, and those really expensive branding consultants actually driving value to the customer? Or are they just subsidizing the aesthetic of feeling like a successful entrepreneur?
That is so true. Your P&L doesn't just track your money, it tracks your true priorities.
Exactly. The math never lies about what you actually value. If you want to read more, check out our blog at intothemargins.com/playbook.
We truly hope this deep dive helped clarify and reframe one of the most vital, non-negotiable tools in your entrepreneurial toolkit.
We really do.
If you found value in this breakdown, please be sure to like, subscribe, and drop a comment below. We'd absolutely love to hear how you are implementing these tracking habits and facing these data truths in your own operations.
And remember to check out our deep catalog of other deep dives where we continuously unpack the strategies, the psychology, and the hidden mechanics of profitable growth. Thank you so much for spending your valuable time with us today. Keep your eyes on the dashboard, keep protecting those margins, and we will see you on the next